Is there another leg down for the stock market? Disaster for bank dividends and more capital raisings. Why are businesses doing that? I'm Peter Switzer.
I'm Paul Rickard, and we're mad about money.
Well, the big question I'm getting, Paul, and everyone's asking you, I'm sure, is will there be another leg down for the stock market, or is the worst passes and it's all the way up now?
Well, Peter, I think we're going to work around 5,000. I've been saying that now for a couple of weeks.
Where are we now?
We're about 5,200, but I think we're going to head back a little bit today. I'm not ruling out another leg down. I think the issue now look, the three things needed to happen. One was we got governments through the kitchen sink. The central banks was the second thing. Now we're starting to get the sort of slowing in the data. At least that's all positive.
Yep.
The question now people are starting to ask is just how long does the disruption go for?
Is it 6 months or shorter?
How quickly can they come back to normal? And I think that's going to be influenced a little bit by actions from governments, and that's where the sort of the dip down could occur again. Because if that looks like it's going on longer, it means the recovery is going to take.
Because it's going to be harder for companies to make profit.
Yep.
If they can't make profit easily, down goes the share price. One thing I'll throw in, ladies and gentlemen, is Austria is planning on opening up small shops by the middle of April and larger, like department stores, by end of April, and hotels, restaurants sometime in May, if the first part works. And that's what it's going to be. I think it'll be a staggered comeback to normalcy.
I think there'll be enormous pressure on the Morrison government after Easter. We could probably all survive through Easter. Yeah. After Easter, just watch that pressure build, because people are going to go crazy. So the question is how they do it, and the same is going to apply in the States. So you've seen a couple of nights in New York getting a bit excited by data one day, not so excited the next day. Same issue there, and just what that means for profits and so forth.
Donald Trump says that the US economy is like a rocket ready to roll.
Rocket, yep.
So he's gonna push for an early comeback. Let's go to the disaster for banking dividends.
Well, it's not a disaster.
What's going on, Paul?
It's not a disaster, Peter, but I guess we sort of said this may happen. APRA has put out a statement to the banks saying, look, if you want to pay a dividend in the next couple of months, it's okay, but you really need to pass some stress tests with us first to show that you can do it.
You're in good shape.
Yep, you're in good shape. And what's more, we're likely to say anyhow it's going to be reduced on last year. So
that happens in big markets.
That happens.
Selves.
So of the three major banks coming up, we've got three banks: NAB, Westpac, and ANZ due to produce their half-year profits in the first week of May. There's now going to be more pressure on them. Maybe one of them may not pay a dividend, and two are certainly going to be cut. That seems to be the market talk. Bank of Queensland this morning. Now it announced its half-year profit, which is okay, but it's not a bank on fire. But it's not paying a dividend, Peter. And the main reason it's not paying a dividend is this APRA announcement came out yesterday. It hasn't done the stress testing with APRA to satisfy it. Its capital ratio is also in the lower calibre, so no dividend from Bank of Queensland. So that's probably going to make it easier for the other three to be a little more conservative. So it is a disaster for bank dividends. Well, it's going to be tough on self-funded retirees in the next few months. We're all going to do this tough.
Yeah. Finally, we're seeing lots of companies going for capital raisings. What's the history of this, Paul?
Well, the history of this, Peter, is that whenever markets get under pressure, and particularly when we have a revenue and business disruption like we're seeing, analysts, investors look at companies, they look at leverage, they look at all the question about how the company's going to survive 3 or 6 months on reduced income. And many companies' cases, they've got to raise capital because they won't survive. And the market is really good at extracting this. When I say the market, I said the market puts so much pressure that boards have no option but to raise capital. Yeah. I have been saying this now, a bit of broken record now for some weeks. This was one of the big takes out of the GFC.
You said that.
Almost every company was forced to raise capital over that period, and the time to buy was when they raised capital, right?
And so you're saying that it drives the share price down in the short term, but with this money and then with the ultimate recovery, the share price does come back, so it becomes a buying opportunity. So what's the companies doing capital raising?
That back to our first story is one of the reasons why I'm not sure we haven't seen more dips down here, Peter, because there is going to be a lot of chance for shareholders to buy through capital raisings. that means less demand in the market and means it's going to be harder to go up. So, we saw the classic, we've seen it with people stocks like Flight Centre, we've seen it with Auckland Airport, we've seen it with Cochlear, we've seen it with Webjet. There are a lot more to come, Peter. They've already happened. So if you're in some of these companies that have doing it tough or a bit stretched, I reckon you hang on. Don't be tempted to go in there yet, because the chances are there'll be a raising.
Okay, I'm Peter Switzer.
I'm Paul Rickard.
And we're
mad about money.